Hi everyone, I hope you're all doing well, and today I'm going to be talking about, is it a good thing to be buying stocks at 52-week highs? And this is kind of a video that I think you guys have kind of asked for, and my thoughts at buying stocks when they're kind of getting to all-time highs or 52-week highs, and if that's still an opportunity to go buy into it. And it's kind of one of those more of a stock market tips video that I'm doing today rather than my kind of individual stocks. And you guys really do seem to be enjoying these sort of videos that are helping you out. I know I do have quite a few beginners on the channel, so hopefully you find this one a little bit useful as well. So if you could smash the like button, subscribe if you're new here, that would be absolutely amazing. I think we've just passed the 3,000 subscriber mark on YouTube, which is fantastic, so thank you so much for that. Kind of on the way to 5,000 subscribers I guess now, so yeah, kind of crazy. Kind of like a small football stadium filled up, so hopefully we can kind of push up now to a little bit of a bigger football stadium, so let's see what happens. But yeah, we're going to be talking about, is it a good thing to be buying stocks at 52-week highs? So first of all, I would say it depends on your investing philosophy. Now when I look at my philosophy, I kind of buy stocks for 2 to 5 years hold. Some of you guys might be invested into stocks that you're never going to sell. Some of you guys might be invested into stocks that you plan to hold for 5 to 10 years. But if you're kind of invested for like a day or a week, then this channel isn't really for you. But if you're an investor rather than a trader, obviously you're going to be holding for a longer term, so that's something just to take into consideration. And it also depends on what you kind of look for in stocks. Personally, I look at share price growth of over 100%, and that's where I buy into companies, and I've kind of got to meet that criteria for me to invest in it, where I'd be able to get 100% return from. So first of all, if you're invested into a company and it is trading at a premium, trading at 52-week highs, and you think this company is going to do fantastic in the long term, then sure, you could buy into the stock at all-time highs, and over the next 5 years, 10 years, probably more of the longer spectrum, you probably actually see some results from buying into that company. The problem is that you're kind of buying after everyone else has bought in, and eventually at some point you run out of sellers. There's not many kind of stock market charts that kind of do this up in a straight line. When you look into a stock market chart, what you kind of do is you have a stock market chart that probably looks something on the lines of that. It's very rare that you get a stock market chart that will go straight up in a line. Most of the time when you look at a stock market chart over a 5-year period on Google, you'd see the stock has this sort of trend going on. It will go up in the long term. Stocks in the long term are bullish, and you make money on the stock market from investing. It's one of the easiest ways to make money. But when you look at a chart, you'll see a lot of patterns where you'll see a couple of dips into the stock market chart, and you'll see if you do buy somewhere in them sort of regions, when you do see these dips, you get it back at prices that were extremely cheap or a long time ago, and you'll have a bigger jump. How many of you guys here were people that were buying in the dip of COVID? If some of you guys were picking up stocks in March, April time, I'm sure you've got quite a few stocks that are up quite high percentages, and that's because you were able to buy them a lot cheaper, and you bought them on the dips when they were cheaper, and you make them gains. If you're buying the stocks in January, February time, when the stock market was getting towards highs and 52-week highs, I'm sure some of you guys are now down in your positions, or you kind of recovered it and you're pretty much flat. And that's kind of one of the big differences, is that you will get them opportunities, and when you do buy in them opportunities, you'll easily get a bigger return than when you do buy at the highs, because you're kind of running out of buyers. The stock market can't go up in a straight line, it has to pull back sometimes. So that's something to take into consideration. Now there is a couple of times I would buy at 52-week highs, and that's where the company, even if the stock market chart is here, or at the high points here, I would still be willing to buy that company. If I look at the company and I still go, this company is an extreme cheaply valuation. If it's near highs and I look at a company and it's a growth company that's growing at no debt on the balance sheet, growing at 30% revenue every year, and it's at 52-week highs, and it's like a forward P of 20 or below, I'm like, that's a forward P of 20 on a growth company with massive growth. I'm like, that's extremely cheap for a growth company at that sort of revenue price. And then I'll be like, yeah, I'll buy that. And it depends on the exact valuation, what's going on, but more than likely that's a very big rarity. Most of the times when you talk about growth companies, they'll have no profit and no forward PE, and you'll be talking about potentially a company that is a very high PE and these sort of highs with a very high valuation. So if the valuation is extremely cheap, then I might take a punt on it. But most of the time, it's a lot of companies at a high valuation at 52-week highs, and I'm more than likely going to be avoiding them. And another reason why I would potentially avoid a company at 52-week highs, even if I really like them, there's a lot of companies that I like, but I won't buy at 52-week highs. Apple, Amazon, Google, big fan of the companies. People ask me, what do you think of the companies? I think great companies, just the valuation isn't right for me, and that's why I'm not invested in them. Something like, let's say I was going to buy a company at $300, for example, and I believe that in 2 years' time, this company has the potential to maybe go up to $400. At the end of the day, that's going to give me something just above a 30% return, which in kind of holding stock for 2 years isn't really that much. 30% return isn't absolutely huge. But if I look somewhere out in the market and I'm able to find a company very similar at a lot cheaper valuation, a company that's kind of dropped, or even if this company was to drop, and I was able to find a company for 200 and I hold it for 2 years the same, and then I sold it for 400, then we talk about that I've just made 100% return on the company. So if you were able to get that 300 company at 200, you would actually have the potential to make 100% return, rather than if you were going to buy it at 300 and you make 30% return. So just waiting for that little price drop will give you that better valuation where you'll be able to make a bigger percentage on your return. Or if there's another opportunity out there in the stock market that gives you the potential to make a bigger return, then that's probably the one that you're going to go for. So you kind of got to justify where the stock valuation is, and then you got to kind of look at it as well and think, if I buy it 52-week highs and I'm only going to make 30% in 2 years, what's the point of buying that stock? Maybe in 5 years you might make even more than it, and you'll probably still do okay, but you've got to work out a thing for the risk and what reward you get. Is it better to look for another company where you will make bigger returns? And that's what you've always got to look at. And that's sometimes why I sell stocks as well, is when I look at a company and I go, I'm up loads, but what's the upside from here? 20%, 30%? Is there another opportunity out there in the stock market where I'm looking at this company now, and that's potentially a company that I go and make 100% return on, and that's when I sell that company and then move it into another company. So you've got to kind of balance up that reward and risk, and see what valuation you could probably get out of that company as well. And that's something to be really careful of when you're looking at companies that are at 52-week highs. So hopefully that kind of clears a few things up with you, about buying companies at high, and these are big reasons why I don't buy companies at 52-week highs, just because of how much limited upside you do have when you do buy at the 52-week highs. So I hope that made it a little bit clearer. If you did enjoy the video, if you can hit the like button, that'd be absolutely amazing. If you're new around here, subscribe, and I'll see you in the next video.